Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host for Upticks. Today is our 55th episode, The Fed Lowers Rates. All right, Jesse, welcome back to the show.
Thank you for having me on.
Yeah, I think it's been a few weeks since you've been here. For everyone tuning in or listening to us on iTunes, I kicked Corey out again. He's got meetings today. And so we brought on Jesse back onto the show because as of the recording of this show, the Fed has made a very important announcement. Actually, they've done something that they haven't done in 11 years. And Jesse and I wanted to talk about it and talk more specifically how it could impact your portfolio. So Jesse, why don't you just kind of roll out what the Fed is, what they do, and why we should even care about what's going on.
Right, so the Federal Reserve, or the Federal Open Market Committee, they make decisions on interest rates, and they have two mandates, which are unemployment and inflation. So they're chaired by Jerome Powell, who was nominated by Donald Trump, and they kind of comment on the economy, which in turn affects the market, the stock market, the bond market, all of that. So.
Gotcha. So this committee meets regularly throughout the year.
Yep.
And their job is to help control the unemployment number and inflation.
Correct.
And they are controlling, I guess, the money supply through interest rates.
Right.
So either raising the rate, or they lower the rate, or they leave it fixed.
Right.
Right. So just this week, for the first time in 11 years.
Yeah, over a decade since before the financial crisis, or right in the middle of it.
Right. So they lowered the rates by 1/4 of a point. Right. So what does that mean? How is the market reacting? Why should the everyday investor care about that? Or how does that impact them?
Right. So I guess the first thing that you'd want to start off with there is that typically when the Fed when they start lowering rates, that's an indication that there could be a recession around the corner. So typically, that'll directly follow when they begin their easing cycle. That hasn't happened 3 times, one time in the 60s, one time in 1995, and then 98. So there have been a few occasions where that hasn't followed, the recession hasn't followed them starting to lower rates. It is important because it is, like you said, it's the first time it's happened in over a decade. So it's very important to the market. And the reason why they're doing it this time is not the unemployment number, it's more about inflation. So inflation is a little bit below the target that they want right now, which is around 2%. So they're trying to get inflation up, and that's kind of the main reason behind that. And then there's a few economic reasons. Some of the numbers
Let me interrupt you there if you don't mind. So a lot of people will ask me, why do we want inflation? Why are they trying to get the inflation number up?
What you really don't want is deflation. So
Gotcha.
That's what Japan has dealt with in the past, and it's just not something that you want, because then you get to a point where no amount of Fed policy moves are going to help get away from that deflation. So you don't want the value of your goods getting less over time. You want them to appreciate over time.
Is that because consumption then lowers as a result?
Yeah, consumption will increase when interest rates decrease.
Gotcha.
Because when you put your money in the bank, you're not getting the highest interest rates. So you'd rather just spend the money now rather than defer consumption to the future.
And what I was thinking more too is deflation. If I wanted to go buy new tires for my car, and I knew that they were just going to get cheaper over time, I would hold off on buying those. Right, which in turn actually hurts the overall economy.
Or think about housing or cars or any big purchase like that. You want those, especially, maybe not cars, but especially housing, you want those to appreciate over time so you can sell them at a profit in the future.
Gotcha.
And that's, those are the things that will go down in value that you don't want to go down in value.
And doesn't the Fed typically target inflation at what, between 2 and 3%?
Yeah, 2% is around the target that they're looking for.
And you're saying currently it's running at less than 2?
Yeah, less than 2 right now.
Gotcha. So they lowered rates. And what I heard from the announcement also is that maybe this wasn't a signal that a recession is looming like you talked about. It's more about a precautionary or a preemptive adjustment.
Right, yeah. So Jerome Powell called it a mid-cycle adjustment. So what we saw after, which I think we can get into a little bit, was the stock market sell-off afterwards. So I think the stock market was looking for even more of a dovish or more just kind of an indication that they would lower rates more in the future. And that's not really what the indication that Jerome Powell gave. He called it a mid-cycle adjustment. He said that this doesn't necessarily mean the beginning of a long series of cuts.
Gotcha.
So this could just be one cut, and then we could go back to hiking. He's kind of giving both a reason to potentially happen in the future. So
does the market not like that because it also maybe creates a little bit more uncertainty?
Yeah, I think there's the uncertainty around the Fed, and then the fact that they were kind of pricing in more rate cuts throughout the rest of the year.
Gotcha. So yeah, he could raise rates in September, right? Just as easily as he just lowered them.
Yeah, I don't think he could, and I don't think that's something that'll happen. But it is important that there were two dissenting opinions, which hasn't happened since December 2017. So two of the presidents of the Federal Reserve of Boston and Kansas City actually were against lowering rates. So
Gotcha.
That's another less dovish signal that maybe we're not going to be lowering rates as much as we thought this year.
Interesting. And why does the market, why would they want rates to be lowered right now? Why did the market go down by them? I get what you're saying, that they didn't lower as much or didn't indicate that they were going to lower on a progressive time frame. But why does the stock market behave that way? Why does it care?
So why would they want interest rates lower?
Right.
So it makes it a lot easier on companies, especially when they're talking about their debt.
Gotcha.
So companies that could potentially, if the rates increase, they could have problems with refinancing their debt or even paying off their debt obligations. Those worries kind of go away when interest rates are lower. And more, like we said, more people are going to be spending money, so they're going to be spending more on goods and services that could potentially help stock prices, sales, all of that. So.
Interesting. Okay. I know you've recently written a blog about this. Is there anything else that maybe you've researched or wanted to comment on as it pertains to the market? I wanted to talk a little bit about the planning side of it and how you can take advantage of the Fed lowering rates. But what about anything else on the market that we left out, or what are we looking at now?
I would say the bond market is going to become especially important. There are people that think that the Fed funds rate could get down to zero. Right now it's at 2. The target's between 2 and 2.5. So if it gets down to zero, like those treasuries will especially become important because people are gonna pile into those. So having those could appreciate a lot over the coming months. So I think treasuries, bonds are the most important part of the portfolio. And then as we talk about a potential recession, the bond portfolio is going to become a lot more important than the stock portfolio in hedging that risk.
Gotcha. Yeah, and that's another reason that we don't just simply buy and hold bonds. We typically do a laddering strategy, which causes us to reinvest as bonds mature, and we take advantage of these interest rate movements when we're selecting the individual bonds.
Right.
And because we're independent, we don't have an inventory that we have to pull from. Jesse's looking at the broad bond market when making these important decisions. So that's good. Also on the bonds, another good piece for our clients is that since we're not charging a markup, we can get some pretty good pricing when that's all said and done as well.
Right. And then, when we're talking about the treasuries, we've recently gone into buying CDs because they have a better yield right now.
Right.
So those treasuries that we do have will be appreciating, but we also have the CDs who are going to pay us a better interest rate than those other ones would.
Perfect.
Treasuries. So
yeah, so it's a good time to take a look at your bond portfolio. Obviously, if you're watching or listening to this, and you want a second opinion and you want us to look at your bond holdings, if you're not working with Falcon Wealth Advisors, we're happy to do that as well.
Yep.
One thing I wanted to point out from a planning perspective, if interest rates are lowered, now that should translate into bank loans and mortgages and other things dropping as well. So this is a good time to potentially look at refinancing some debt. So if you have some debt in there that's locked in at a higher rate, it's a great time to look at refinancing, certainly.
Yeah, that's exactly the opposite of what we're trying to do. As far as the bonds, we want those bonds with the high interest rates.
Yeah, exactly. So on a planning perspective, low rates is actually okay. It's okay on a debt perspective. Jesse's job now is to try to figure it out through the bond market. We'll let him worry about that.
Yeah.
But when I'm working on planning with my clients and rates go down, it's a great time to look at refinancing your mortgage. If you've got some variable debt in there, that rate should be dropping. Or if you have some high fixed debt in there, it's definitely worth a look at refinancing some of that and taking advantage of these rates as they lower. Again, we don't know what they're going to do in September. They could lower them more, they could leave them unchanged, or they could raise them. But we know now for today they're lower. And so if you have a high interest rate, it might be worth looking at refinancing some of that. Or if you did want to take out a mortgage or a loan, rates are lower now. So it's a good time to lock in some of that debt. And that's something certainly that myself, Corey, or James are happy to sit down with you and look at your financial plan and help you make some of those big decisions. Perfect. Is there anything else? So it sounds like we're obviously staying very nimble in our stock portfolio. Stocks should like this. But again, if they aren't as dovish as we had anticipated, the waters might continue to be a little rough here.
Yeah.
So we might see a pickup in volatility, certainly with more news as it comes out of Washington and around the country. And again, we're going to pay close attention to your bond portfolio.
Right.
Was there anything else you wanted to talk about?
I think that's it. I think we covered everything, and it might get a little bit more volatile when we're still in this trade war with China. That's still definitely a catalyst in the market, and put that on top of the Fed lowering rates. It's kind of a volatile time in the market. But
Yep, and that's job security for us. That's what our clients pay us for. Because we're picking the individual stocks, we're able to help make good decisions around that volatility.
Right.
Now, we've already done the lightning round with you, Jesse, and we already talked about how you learned about money. So typically, once we've done that with my guests on the show, I'd just like to maybe get a current life update. Is there any good book you're reading out there? I know, you kind of are winding into summer here. Are there any new shows you're watching or anything you want to share with our audience as far as maybe some recommendations for you?
I just read the book Sharp Objects by Gillian Flynn.
Okay.
Gillian Flynn, and it's a show on HBO as well with Amy Adams. But the book is incredible, and it's the girl who wrote Gone Girl.
Okay.
And then I just started the book Dark Places by her after I read Sharp Objects because it was so good, and they're both incredible books.
So are these novels? Okay.
They're fiction, but they're both set. One's set in Kansas City. Dark Places is set in Kansas City.
Oh, I didn't know that.
Yeah, and then so she went to KU.
Okay.
So all her books are set in the Kansas, Missouri area, which is pretty cool.
That is pretty cool.
Yeah. So those are.
What's it about?
Good. They're kind of dark. That's the only thing. Gone Girl is pretty dark as well.
Yeah.
But I would just look them up. I don't want to spoil it for anyone.
Gotcha. And then without another spoiler alert, you also were telling me the other day that new Quentin Tarantino movie is really good.
Yes, Once Upon a Time in Hollywood. Really good movie.
I got to get my wife. I'm trying to convince her to go see it.
Yeah, it's a great movie.
You think she'll enjoy it?
I think everyone can enjoy it if you know the history behind it. And I can't say more because it would spoil it.
Gotcha.
So,
okay. Yeah. Perfect. So those are two good recommendations out there. Well, again, thank you for taking some time out of your day. I know you're busy in there trading for our clients and doing the research. But as always, we appreciate everyone tuning in. And whether you're watching this on YouTube or listening via podcast, please subscribe, like our content. If you do have any suggestions, we're certainly always open to those ideas. And you can find me if you're out there on Twitter. I'm out there posting on Twitter on and off. My Twitter handle is Jake Falcon, at Jake Falcon CRPC. And I think, Jesse, you prefer email?
Yeah, just email me at Jesse at Falcon Wealth Advisors.
Perfect. Thanks again for tuning in, and we hope you all have a great week.